Hi everybody, this is Don Black from Portland, Oregon. But I'm talking to you today from Berlin, Germany, where I live and work as an American lawyer. That makes me one of the 6 million or so Americans living and working abroad. Most Americans who travel abroad to live and work don't realize that they carry with them their U.S. tax obligation. That's because U.S. taxes are based on citizenship and not place of abode or locale. Therefore, every year, all American citizens and permanent residents, the so-called green card holders, are taxed on their worldwide income. Well, that's the bad news. The good news is, if you are an American living and working abroad, although you have to report and file for your U.S. income taxes, you probably won't owe any income tax at all. And that's the purpose of this short 10-minute public service video to introduce you to the basics and, time permitting, give a few examples for overseas filing. First of all, if you are living and working abroad, you will receive from the IRS in America this booklet with forms, instructions, and publications for filing abroad. Everything you need to know. Now, if you haven't got it and can't get it, don't worry. Just go to www.irs.gov and you can download all the forms, instructions, and publications you need. The most important publication for filing overseas is publication 54. Well, let's get down to our first example. Our first example is Jim. Jim earned $75,000 in the USA from abroad. First, all foreign earned income in the foreign currencies must be converted to the US dollar before being reported to the IRS. But what conversion rate do you use? No problem here either. Just go to the home page of the United States Department of Treasury, search for exchange rates, and you'll soon have all the information that you need. Turning again to Jim, he reports the $75,000 earned abroad on his 1040 form. Then he gets his line 40 deduction in 2008, 5450, that's $5,450. His line 42 single exemption in 2008, that's $3,500, giving him taxable income of $66,050. We look at the 2008 tax table and we see that Jim owes $12,850. Poor Jim. Example 2. John. John also earned $75,000 abroad, but John was living abroad. This is the difference. Jim was back home in the U.S. and John was living abroad. Well, John reports the $75,000 after foreign currency conversion on the 1040 form. But John can do something more. He takes form 2555, that's 2555, which is the foreign earned income exclusion form, and he can exclude now $87,600 for 2008 of foreign earned income. And $87,600 is more than $75,000, so John has excluded his entire income and owes no U.S. tax. Example 3 is Sally. Sally worked in Paris and she earned $125,000, and $19,500 of which was for her housing and was paid by her company. Well, after conversion from the foreign currency, here the euro, Sally enters the $125,000 on the 1040 form. Then she executes the foreign earned income exclusion on form 2555 and enters a result on line 21. For Sally, the full amount of $87,600. Sally also gets a foreign housing exclusion. Based on her position in Paris, that is $5,484. This is added in to the foreign earned income exclusion, and the total is entered on line 21, leaving Sally with adjusted gross income on line 38 of the 1040 form of $31,916. Now Sally takes her line 40 deduction and her line 42 exemption, and this brings her taxable income down to $22,966. We look at the 2008 tax table and we see that Sally's tax would be $3,045, but Sally is living and working in Paris, where she has to pay high French income tax. Therefore, she gets the foreign tax credit also. Thus, Sally fills out Form 1116, that's 1116. She enters the result on line 47 on the 1040 form, and she pays no American tax whatsoever. Example 4 is Mabel. Mabel is self-employed in Berlin and also earned $125,000 and also paid $19,500 for housing costs. At first, Mabel and Sally would seem the same, but Mabel is self-employed and this makes for a difference. First, Mabel reports the $125,000 on the 1040 form. Then Mabel takes the $87,600 foreign earned income exclusion and enters the result on line 21. She cannot exclude her housing costs, but she can deduct them on line 36. Her deduction is identical to Sally's, $5,484, leaving her on line 38 the identical adjusted gross income of Sally. She now, like Sally, takes her line 40 deduction, her line 42 exemption, leaving her, just like Sally, with $22,966 of taxable income. But, just like Sally, she's paid high foreign income taxes overseas to a foreign government. Therefore, she takes the foreign tax credit. She fills out Form 1116, enters a result on line 47, and pays no U.S. taxes whatsoever. Alternative minimum taxation. Under these simple examples, neither Mabel nor Sally will owe any alternative minimum tax. This position could change if either itemizes her tax on Schedule A. Increased deductions and credits can often lead to the alternative minimum tax in the USA, even for overseas filers. Self-employment tax and FICA. The U.S. self-employment tax, and this is for self-employed people, Schedule SE on the 1040 form, is a completely different tax to the U.S. income tax. Therefore, the Form 2555 exclusion does not apply to Social Security tax, which is currently at 15.3%. Fortunately, the U.S. self-employment tax can be lawfully avoided from overseas under any one of the many bilateral Social Security treaties called totalization agreements from abroad. The USA has totalization agreements with both France and Germany. Sally, as an employee, would get an automatic exemption from the U.S. Social Security tax. That's the FICA tax. But unless Mabel actually contributes to the German Social Security scheme, she will have to pay the U.S. self-employment tax of 15.3% in the U.S., even if she owes no U.S. income tax. And since the German retirement scheme is voluntary, Mabel better sign up to pay contributions so that she will not be liable for the American self-employment tax. Example 5 is George W., a U.S. citizen living abroad in Country X. He became unemployed in 2008 and collected Country X unemployment benefits. He also had Country X bank interest and Country X rental income and a Country X capital gain, all amounting to $60,000. None of the above is earned income. All of the above is unearned income. Unearned income does not qualify for the Form 2555 earned income exclusion. However, if George W. should pay income tax to Country X on any of these earnings for unearned income, then he could take the foreign tax credit on Form 1116. I hope this has helped you, and I want to thank you for watching. Remember, tax is a difficult and serious business, so be sure that you do it right. If you have any questions, please consult your tax attorney or your tax advisor. Thanks again, and have a nice day.